Can you invest ethically without sacrificing your financial stability? Well, it's pretty much the ultimate question for today's conscientious investor, right? For the longest time, there's been this lingering assumption that if you really want to align your portfolio with your personal values, you automatically have to settle for lower returns or just deal with higher volatility. But what if that's actually a false compromise? What if you could find an asset that acts like a total fortress during economic turbulence, pays out consistent rewards, and passes the absolute strictest ethical screens out there? That's exactly the puzzle we're going to solve in today's explainer.
To do this, we're zooming in on a real-world case study today, Scientex Berhad. This company is a true heavyweight on the Bursa Malaysia exchange. By breaking down the actual anatomy of this specific stock from the outside in, we'll see exactly how a business can perfectly balance aggressive global growth with strict ethical compliance and, of course, really robust financial health.
Okay, let's dive right into this. Here's our roadmap for the explainer. First up, we'll look at a balanced business model. Second, ethics and Sharia compliance. Third, a 50-day window of stock behavior. Fourth, financial health and valuation. And finally, we'll wrap up with the macroeconomic big picture.
All right, let's kick things off with Section 1, a balanced business model.
So right off the bat, Scientex isn't some unproven startup. Actually, they were founded way back in 1968, originally starting out making PVC leather cloth and sheeting. But, they definitely didn't stay small. Over the decades, they've evolved into literally one of the largest stretch film producers on the planet. We're talking about a massive manufacturing division here, one that covers the entire packaging value chain, exporting flexible industrial packaging to over 60 countries across 5 different continents. That kind of global footprint brings in some immense revenue potential.
But here's the really clever part of their strategy. They don't just rely on those global packaging exports. No, they pair that with a completely different sector, affordable property development, right at home in Malaysia. It basically acts as a built-in safety net. Think about it. When global export markets face headwinds, the stable, consistent revenue from fulfilling local middle-class demand for affordable housing just props right up the balance sheet. These two completely distinct sectors, they just perfectly complement each other.
Moving right along to Section 2, Ethics and Sharia Compliance.
Scientex is officially classified as Sharia compliant by the Securities Commission Malaysia. Now, if you aren't super familiar with what that entails, let me tell you, it is definitely not just a rubber stamp. To actually get this status, a company has to undergo really rigorous, incredibly strict screening by the Sharia Advisory Council. They look deep into the business operations and financial activities to ensure everything completely satisfies Islamic principles. For Muslim investors seeking permissible halal investments, this official classification is absolutely paramount.
But their ethical commitments actually go way beyond that, aligning beautifully with broader ESG, or environmental, social, and governance principles. By investing here, you're essentially crowdsourcing capital into a company that actively pioneers eco-friendly, greener packaging innovations. And socially, their entire property division is dedicated to affordable housing, which directly improves the well-being of the Malaysian middle class. It's just a fantastic example of corporate social responsibility translating into tangible, real-world impact.
Okay, let's look at the actual charts in Section 3, 50 days of stock behavior.
So, if we track this recent 50-day window, we actually see a story of a stock passing a pretty serious stress test. In Step 1, right around mid-April, the stock hit a low of 3 ringgit and 47 cent. But watch what happens in Step 2. By late April, there is this massive surge in trading volume, pushing the price all the way up to 3.79. Then, moving into May for Step 3, we see some significant volatility. The price drops back down to 3.62, likely driven by, short-term profit-taking or shifting macro sentiments. But, and here's the key, it didn't spiral. Instead, it immediately bounced back into Step 4, entering a nice calm consolidation phase in June, trading really steadily between 375 and 382, with moderate volume.
And honestly, this just brilliantly illustrates the stock's underlying resilience. Those sharp declines, they were almost instantly restored. What this tells us is that whenever the price dipped, long-term investors saw it as a prime buying opportunity, stepping right in to provide really strong fundamental support. It proves, without a doubt, that the market has deep confidence in this company's ability to weather short-term economic bumps.
Which brings us to Section 4, Financial Health and Valuation. Let's look under the hood.
Now, what's really interesting about this first metric is their return on equity, or ROE, sitting right at 13.81%. While the absolute ideal benchmark for some hardline analyst is 15%, an ROE of nearly 14% is honestly incredibly strong.
It shows us that the management team is highly efficient at taking shareholders' capital and turning it into consistent, reliable earnings, even while operating in those highly competitive packaging and property sectors.
Next up is their valuation, represented by a price-to-earnings, or PE ratio, of 10.29. This basically tells us exactly how the market is pricing their future earnings. It's a moderate number, which means the stock is definitely not wildly overpriced. However, as we're going to see in just a second, it does indicate that long-term investors are totally willing to pay just a slight premium here, simply because the growth prospects are so incredibly reliable.
Finally, we have a dividend yield of 3.14%. For those of you out there looking for passive income, this is a really solid, stable reward. But what's absolutely crucial to understand here is that it's a moderate yield. The company isn't bleeding all its cash just to pay off shareholders. Actually, they're using a much more balanced strategy, smartly retaining a significant chunk of their earnings to reinvest right back into the business. And that's exactly what fuels that massive global expansion we talked about earlier.
So, when we synthesize all these rapid-fire numbers and benchmark them directly against the broader industry average, the overall picture of stability becomes crystal clear. Their PE of 10.29 is just a hair above the industry average of 9.81. Their dividend of 3.14% is slightly below the industry's 3.65%, which, again, totally proves that smart reinvestment strategy. But get a load of that debt-to-equity ratio. Scientex sits at 47.85%, which is almost perfectly aligned with the industry average of 47.58%. This proves they have a highly prudent, tightly controlled reliance on borrowed funds, which massively reduces their long-term financial risk.
Let's zoom out for our final piece of the puzzle, Section 5, the macroeconomic big picture.
When we actually look at the macro factors in Malaysia right now, the environment is perfectly primed for a company exactly like this. The overnight policy rate sits super steady at 2.75%, which guarantees that the company's borrowing costs remain perfectly stable. Meanwhile, inflation is hovering around a very manageable 2%, protecting consumer purchasing power and keeping Scientex's raw material costs totally in check. And with an average GDP growth of around 4 to 5%, there's just this constant, strong domestic demand fueling both their industrial packaging and, most importantly, those affordable housing developments. The wind is well and truly at their backs here.
So what does this all mean? The crucial point is this. When you combine a dual-engine business model, strict Sharia and ESG compliance, proven stock resilience in the market, and really prudent financial management backed by strong macro tailwinds, you get exactly what our source material concluded. Scientex Berhad is, quote, a sound investment option with moderately high profits, minimal risk, and good ethics. They absolutely prove that you just don't have to compromise.
Which brings us to our final thought for this explainer. Take a moment today to really look at the assets you're currently holding. When you apply this kind of comprehensive, analytical lens to them, how does your own portfolio actually measure up against this balance of performance, resilience, and ethics? It's definitely a high bar, but as we've seen today, it's absolutely achievable. Keep analyzing, keep learning, and as always, stay focused out there.